Bleak corporate earnings dampened European equities, but rose the fall following the Fed decision and improved market sentiment. So with a European Central Bank decision next month, our next guest says that they will probably be the first to cut of the central banks out there. Joining me today to discuss the latest on the European market moves that we've seen and those to come, including the sector winners that are on his radar, is Fidelity Europe Fund portfolio manager Matt Siddle. Hi, Matt. How are you doing? Nice to see you.
I'm good. Good to see you, Pamela.
Yeah, nice to see you as well. We'll invite everyone joining you here today, to send their questions in over the next 30 minutes or so. Such an interesting story to take a look at Europe. Let's dive in a little bit. We mentioned the central bank story, where cuts may need to be. But I wonder if we can even just put rate cuts to the side for a second and dive into the earnings story, the growth story at companies. We've seen a relative story develop. I wonder if you can sort of sketch the outlines of where we're seeing growth in European equities versus US at this point.
Yeah, certainly if you were to look at earnings growth, the US market has seen stronger earnings growth. I think if you were particularly looking at that breakdown, a lot of that comes from a fairly small group of companies. In fact, a lot of US earnings growth has come just from those Mag 7, and I think we have a slide that helps to show this. While the Mag 7 see much stronger earnings growth than the other 493 companies in the US market, that's quite different when you look at the split versus international. So, if you were looking at that 493, yes, the Mag 7 has grown earnings massively faster. So the US market has grown earnings massively faster than the European market. But if you were to take out that top layer and look at the rest of the market, then if you were to see the earnings of the S&P 493, which I think you can see there in orange on the slide, and then you were to compare those earnings of the S&P 493 against the rest of the world, so if you compared it against MSCI ex-US, you can see that actually over the last 17 years since the financial crisis, the rest of the US market hasn't really grown earnings a lot faster than the rest of the world. The superior US growth story has very much come from a very small group of companies which have grown earnings tremendously well, much faster than the large cap growth companies in Europe can. But it is very concentrated.
So, I mean, it's very concentrated. And so it brings us to this question that we've been talking about, really since the beginning of the year, is where is the breadth story? Where is the rest? And that is a very interesting story in Europe, because the rest in the US and also the rest in Europe has quite a different valuation story.
Yeah, I mean, this is the thing. The growth of the big 7 US stocks is massively better than the big growth stocks in Europe. So from a growth investing perspective, I can definitely see why people would be more interested in the Mag 7 than the European equivalents. But if you look below that and look at the other companies outside of those top 7 in each case, then the earnings of the US market hasn't really been any faster over the long term. But B, as you pointed out, the valuations are much cheaper. Again, there's another slide here which maybe helps to just illustrate that. And this one breaks down the valuations between the two markets. So you've got European markets in orange and US markets in blue, and you can see how many companies sit in each multiple bucket. And you can just see how many more companies are expensive in the US on multiples of 20, 25, 30 plus times earnings, and how many more companies are on less than 10 times earnings in Europe. And you've effectively got half the European market on less than 15 times earnings. And some of these companies have got weaknesses, but as we just saw a moment ago, if you look at the earnings growth for international markets, it's the same as the S&P 493. It's only the Mag 7 that really have driven that superior US earnings growth. But for valuations for the rest of the market are so much cheaper in Europe, even though the earnings growth is not much dissimilar outside of that sort of Super 7 growth story.
Fascinating. Okay, so there's so many questions that come from that because it's really interesting to see it lined up like that. Okay, so let's layer on the story of interest rates. We are led to believe from comments from Christine Lagarde that the ECB looks like it will be the first. Canada is also, we think, maybe going for the June rate cut, although nobody really knows. Layer on what a rate cut would mean to the overall thesis that you've just shown us there.
Yeah, I mean, obviously, how markets react will very much depend on why we're cutting rates. If this is a mid-cycle rotation and rates can come down without economic damage, then that is really quite positive for markets. And post-rate cut performance has typically been extremely strong. Generally, beneficiaries of lower rates, consumers, stocks, etc., can benefit having had a more difficult time, particularly in Europe. I'm sure some of the people listening will have been on some of these calls in the past where we were talking about the difficulties with the war in Ukraine and how much that pushed up gas prices and energy prices, and people's utility bills exploded upwards. I mean, people are literally paying 3 or 4 times more for their gas than they were the year before, and that's come off. So the gas prices, natural gas prices in Europe have come down, and if rates start to come down as well, then that's clearly going to be very helpful for the consumer budgets, real wage growth improving, accelerating. So that would definitely be a positive. Then obviously you've got the other option, which is if the economy is slowing, sometimes rate cuts are a sign that the economy is weakening and we're potentially entering a recession. That the markets don't feel that's the case at the moment, but if that did turn out to be the case, then clearly owning deep cyclicals would not be the place to be, and again early cyclicals, which again would count for consumer stocks, and more defensive stocks would tend to be the places to be.
Okay, fantastic. So we'll get into the consumer and something more defensive and where all that fits in the cyclical story. Some European banks have actually been on fire. It's been amazing. It's been sort of amazing to watch the rate story where banks and the story of NIM should work really well in certain cases, but has been actually a slightly divergent story from what might be intuitive. But give us the European bank story and where you've seen some of them do very, very well of late.
Yeah, so the European banking markets, I think, I've said this a couple of times on previous calls, that they're very different between different geographies. So some countries are tied to short-term rates, to say 3 or 12-month interest rates, and are really
countries or companies?
Countries. So the entire Spanish, Italian, Nordic, Scandinavian banking systems would be much more tied to 12-month interest rates, and loans repriced based off 3 or 12-month interest rates. Whereas in Central Europe and Anglo-Saxon economies, they're more tied into sort of 5-year midterm interest rates for a variety of reasons around regulation. And what that means is that some of the banking systems that are more tied to short-term interest rates have really seen a huge benefit in the last 2 years, because interest rates obviously have gone up a long way, and after years of literally making no money or losing money on deposits, suddenly their deposit franchises are profitable because they don't need to pay the full interest rate to their depositors, and they can place that money on loans at a higher rate or place it at the ECB at a higher rate. So net interest margins have exploded upwards in several of these economies, and that's what's driven the very strong performance of, say, the Italian banks or the Spanish banks. But there's probably some...
Is that like Are we done with that though?
Yeah, so I think interest rates have kind of stabilized at this high level for now. And what that means is that the benefit has mostly played through. So I would argue that those economies have probably seen all the benefits they're going to in terms of the banking system and the profitability of the banking system. In fact, the most sensitive area is the Scandinavian banks, and those are actually starting to see declining net interest income in the first quarter compared to the end of last year. So yes, I definitely think that those most sensitive banking systems have seen the best of the benefits, and that story is mostly over. However, the banking systems which are more tied to 5-year interest rates, what matters there is whether the interest rates are not higher versus where they were 3 months ago or 12 months ago. It matters whether the interest rate is higher than it was 5 years ago. And there, clearly, interest rates are still a long way above where they were 5 years ago. So for the banking systems in the UK, France, certain other countries, there's still a lot of benefit still to come through in their interest margins that will help the profitability of some of those banks. And that's where we see the greater opportunities, because for whatever reason, the stock market is putting pretty much the same multiple, if not even slightly cheaper on those banks than it is on the ones where earnings are already at peak.
Let's go to the consumer, often tied to the story of banking as well, but it's got some different components. How healthy is the consumer? This is they're dealing with higher expenses. They were dealing with higher energy, which is now gone. Are there some tailwinds there for the consumer in Europe?
Yeah, no, definitely. You pointed out the higher energy costs have gone, and that's acting as a tailwind. Again, that can be lagged because your electricity bill, your gas bill can be fixed price for a 6 or 12-month period, so you don't necessarily get the benefit immediately. But as things reprice, certainly they're repricing downwards, which means that there may still be some benefit for consumer budgets to come. Again, the UK would be a material beneficiary there because it had one of the biggest jumps. And it's likely to see a repricing downwards that will be supportive. But you've already seen wage growth has accelerated upwards, partly driven by legislation. There are quite widespread minimum wages across Europe, and those are not at very low levels. So, minimum wage can be 2/3 of average earnings. And that means that if minimum wage goes up, 5 or even 10%, in some countries more than 10%, that has a knock-on impact on most people at the bottom half of the wage scale. So that has helped because wage growth has accelerated just as energy costs are coming down. And therefore real wages and disposable incomes definitely started to improve. And you've seen that with some of the retail stocks. So, some of the stocks like Inditex, they own Zara or Primark, AB Foods. But those stocks have started to see a recovery in demand, margins picking up and seeing strong profit growth, which has the potential to continue as consumer budgets but the fixed costs of your utility bill, etc., come down. It frees up some more disposable income.
Right. So interesting. So leaning into the consumer a little bit, sometimes people will say that European markets have sort of a defensive tilt. Take us into looking at the industrials, looking at some of those areas of the market. Are they of interest?
Yeah, so Europe again is quite split. So the European markets that would have a defensive tilt would be the UK and Switzerland. They have a lot of more stable businesses with high returns, more recurring revenues. They're more biased towards traditional defensive sectors like healthcare and staples. Some of the other continental European economies have got slightly more cyclicality. They've got more autos industry. They've got more industrials. Industrials is a bit mixed. So there's some businesses in there which are sort of recurring revenue, businesses which we tend to own, and those can be very defensive. But others, like the capital goods, that can be quite volatile depending on where you are in the economic cycle. So that's a bit of a mixed sector. But certainly, the parts of the market that would tend to do better, be more resilient, be more defensive, would be the UK and Switzerland, in any slowdown scenario.
I mean, in terms of other times to begin shifting investments into Europe, how does this stand out one way or the other? I mean, it is a very interesting time, obviously, on the macro, the interest rate story. I think people do still worry a little bit about the geopolitical discussion there, but it does seem like this story of breadth and cheaper stocks within that grouping of stocks is quite a relative difference in terms of, diversification options for Canadian investors.
Yeah, look, I mean, I strongly believe that if you can buy companies with similar earnings growth at much cheaper valuations, then that is going to prove attractive at some point. Now, the timing of that is difficult to call, because that performance of the Mag 7 sucks people into the US market as a whole, and the other 493 stocks get dragged along with it, even though they don't look as attractive to me as the European markets do. So it's not an easy call on when the timing is, but certainly on a medium-term view, you've got some really strong businesses that the earnings growth isn't simply tied to the European economy because they're multinational businesses. So you've got exposure to global growth as well as what happens in Europe's borders. Valuations are cheap. Consumer budgets are starting to improve. The war's ongoing, but I suspect it probably won't still be going in 3 years' time. It might be going in a year's time. I suspect it won't be going in 3 years' time. So, at some point you can definitely see a catalyst. It's just working out the timing is difficult. That's the tricky part.
There's been a lot of discussion in the last week and a half, has to do perhaps with some CEO visits in China and so on. I just wanted to bring up sort of the idea of trade generally and what it means to European companies at this point. You mentioned multinational. China was a significant part of the export story for European countries. Is it still? Is it growing? Is it slowing? Is it the same? Give us a sense of what China and perhaps India mean to the export story for European stocks.
Yeah, so China is particularly important for German companies. It is the German industrial sector that was most linked to the Chinese expansion phase, partly
Lots of
because
Mercedes.
Yeah, well, not just Mercedes. I mean, obviously, people like their luxury flash cars, and Europe does flash cars quite well. And obviously, Europe does luxury goods quite well as well, with all your Louis Vuitton handbags and Chanel and Prada and all of this. So those are the parts of the European economy that are most tied into China. And that would most affect the German economy. It doesn't affect the French economy too much because, let's face it, luxury goods don't actually involve employing a lot of people. You just pay through the nose for the brand. So it's quite important for the French stock market because it's a large part of the profitability, but it's not many people in France who actually are employed. So it's not so important for the French economy. But outside of Germany, the ties to China aren't huge. It really is Germany, not just the automakers, but a lot of the capital goods. So as China expanded its manufacturing capacity, it needed machines to do it, and the best machines were often German machines. So it was a lot of German mid-sized companies, the Mittelstand, were big exporters of specialist kit to the Chinese as they started building their factories and built automation lines, etc., etc. So it's definitely very important for Germany, less important for other countries.
And India?
French luxury goods. Pardon?
And India?
India is a much smaller economy, but with in my view, better long-term growth prospects. And India would be most tied to the UK economy for cultural, historical, language reasons. Well, our Prime Minister, right? Our Prime Minister is married to the daughter of one of the biggest Indian companies. There's a large
that affects sort of the consumer story of where things ultimately are, from a trade perspective for European countries. Does that
yeah, it does. Unilever is very big in India. There's other consumer companies which have got large exposure to India. So yeah, it's a definite growth driver for some.
We've asked various portfolio managers over the last little while what extent they're looking outside of the US. I mean, AI is happening everywhere. There's no question there seems to be a first mover in the US. I mean, I don't think anyone disputes that. That said, anything of interest on sort of a tech side of things for you? I know that you're looking more from
I mean, I think it's very fair to say that the US companies have got a monopoly, or not a monopoly, but a very strong position in this. What's interesting is that they often built that by buying small British startups. Google bought DeepMind, and so a lot of the work is actually done in Europe. It's owned by the Mag 7, but London is there's quite a lot of computer programmers in London. They're quite big campuses. That said, for European stocks, there are some. One particular one would be SAP, where it's a similar story to Microsoft, where you can use AI and pull information out of your accounting systems, out of your supply chain, etc., and use it to automate. So, but definitely some of the software suppliers have quite a strong opportunity, not to do AI themselves, but to use those AI tools to develop products which other people won't be able to replicate. Because the real advantage of AI is if you've got a unique data set, if you've got control over a unique data set that you can apply AI to, that's where the value is particularly created. And some European companies have some very interesting data businesses. So there are some beneficiaries who maybe aren't doing the AI itself, but can use the tools to drive growth and create new products, etc. So there's definitely opportunities, some of which are in the fund at the moment.
Okay, fascinating. And I guess just kind of take us back to where we began with this, just taking a look at what might be expensive. We were waiting for sort of the breadth story to kick in the S&P 500 as of January. It did. There has been a pullback through April, which we're all familiar with, but still the breadth story for European stocks, just sort of, I guess, make that stark contrast for us in terms of valuations.
Yeah, I mean, look, I think we've had a similar narrow run with large cap growth stocks doing
7 wonders. Is that right?
So there's various names. So Goldman Sachs called them the granolas. There's another bank that calls them the 7 wonders. I think the 7 wonders is a better group than the Goldman's granolas, because several of those granolas aren't really growth stocks, they're just large caps. But if you were to look at the 7 wonders, they've been driving the European market. They've been a large part of the increase over the last few years since COVID. And what's particularly interesting to me is that those stocks now trade on a similar multiple to the Mag 7s. The Mag 7's on about 30 times on average, but the 7 wonders are on about 30 times on average. But the Mag 7's still growing earnings at about 30% a year and has done for 10 or 20 years. Whereas the 7 wonders in Europe are certainly less wonderful or magnificent. They've grown earnings at about 12%, not about 30%, and yet they trade on the same multiple. So to me, you've got this really interesting situation where you've got a group of stocks where people are funneled into, and it's driven concentration to the exclusion of the rest of the market. As we saw earlier, the rest of the market is kind of growing earnings in line with the rest of the US market outside the Mag 7, but it trades on much, much cheaper multiples. So I just see much better opportunities buying companies which are growing at a similar rate to their US peers, but on cheaper multiples, rather than trying to play in the seven wonders, which are on the same expensive multiple of Mag 7, but which with much less growth. And that gap, the Mag 7 is on a 40% premium to the S&P, and that is less than the sort of 10, 20-year average. Whereas in Europe, the seven wonders are not on a 40% premium, they're on a 120% premium to the rest of the market. And that's despite the fact they don't actually outgrow the market as much as the Mag 7 do. So, I just think that there's some really interesting stocks which are being overlooked in Europe, and are, really attractively valued for decent growth.
Matt Siddle, thank you so much for taking us through this story for how the European markets are showing opportunities for investors right now, and through the months to come. Appreciate it, and we wish you a good weekend.
Thank you. Good to speak to you, Pamela.